Hi, I'm Kevin Nuñez, investor, entrepreneur, and professor. I grew up in a part of New York City where nobody was talking about saving or investing. We were in survival mode. I earned my bachelor's degree from Fordham University and an MBA from Cornell University. I worked my way up Wall Street firms like Morgan Stanley and Merrill Lynch. I did everything you're supposed to do. And I could have kept climbing that ladder, but I chose something different. I chose to build. I chose to teach. I chose to invest in our communities because too many families are often fed bad information about money and it costs them generations. So this is Invested in Us, where we break down money, markets, and ownership so our communities can build real wealth and real legacy. Today, we have an incredibly special guest. I'd like to, all of us, to give Vince Childers a nice, warm, Sacred Heart welcoming. I'm honestly thrilled to have Vince here. First of all, in my last lifetime at Morgan Stanley, I had the opportunity to work side by side with Vince and the whole team over at Cohen Steers. Please tell Ben and Tyler and everybody I said hi. I was truly a fan favorite of their strategies. So, I'll let Vince tell the story, but just by way of intro, Cohen Steers is the firm that Vince works for. They're historically known for being a real assets investor. If I'm not mistaken, they're like one of the pioneers in REIT investing.
Yeah, actually, it started in '86, I guess the firm did, and was the first kind of REIT manager, really dedicated REIT manager.
I love that.
So it goes back a long, long time.
You're talking
well
decades,
before me.
Yeah, decades of investing. Great track record. The firm manages billions of dollars in assets under management. It's a publicly traded company. But more importantly, Vince oversees the real assets multi-strategy, products. And, in my last lifetime, I had the opportunity to work side by side by him. I'm no longer at Morgan Stanley, and believe it or not, he still answers my texts. He still answers my calls, even though he doesn't have to, and I'm so grateful for that. He's become not only a mentor, he's become a friend. And when I asked him to spend, 45 minutes with students, he jumped at the chance to be here. So let's make sure we give him a warm welcome. Let's make sure we have some very good questions. Don't ask him what's his favorite stock. He's not going to answer that. But let's make sure that, we have some pressing questions. So with that, Vince, maybe you could just tell us a little bit about yourself and your upbringing and the story overall.
The story. So I guess at the beginning, I have a little bit of a southern accent. And that's because I grew up in Texas, so that explains that. I grew up in small town East Texas. My dad was a chemist at a paper mill. We were country, I guess I would say, in the way we came up. But he kind of climbed his corporate ranks, I guess, at the paper mill and the paper company. Ended up kind of moving up to executive level when I was kind of just starting high school. We moved to Connecticut, and I basically lived in Connecticut outside of going to college, undergrad, and business school for an MBA. Other than that, I've mostly been a Connecticut guy. Let's see. I went to college in Nashville at Vanderbilt back in the 90s when somebody like me could get into Vanderbilt. No way I could get into it in there now, I don't think, but it was a good experience. I actually worked strategy consulting when I came out of undergrad for about a year. Found it kind of totally miserable, creating PowerPoints and figuring out how many people should get laid off of some company. I left that, took a little break, tried to figure out what I wanted to do, and then ended up joining what was then a company called AllianceBernstein, which was basically a kind of investment management firm that was focused on value investing. I worked there for 2 years as, what can I say? I mean, it was a true sort of entry-level position where I was the glorified title was associate portfolio manager. But really what we did was basically just take orders from, the bosses and rebalance accounts for, institutions and clients. However, it was a sort of opportunity. It didn't pay at all, really. It was terrible pay, but it was a great sort of stepping stone for a motivated person to actually sort of leverage it to go to business school. And so that's kind of what my plan was, to say, I'll work here 2 or 3 years. It ended up being about 2.5 years, and sort of treated this kind of a resume builder in a way to kind of get myself into business school. At the time, I was doing the CFA exams, for anybody who's familiar with that whole path, while I was working. Ended up going to business school. Should say at that point I was married. We were lucky enough, accidentally enough, to have a baby in the middle of the first year of business school. Yeah, so that was hectic. And so I had basically a fresh newborn in second year of business school, looking for a job, trying to finish CFA level 3, and then trying to kind of finish well in school. Managed to do all those things, graduated, sold my soul to investment banking because I came out totally broke, again, with a wife and baby. I worked in banking, kind of doing deals. So at that point, starting to do a little bit of restructuring work. I would say banking was never something I really wanted to do, but kind of needed to or achieve, let's say, liftoff for the family at that point. Did banking for a couple of years, and then I actually went back to a bunch of the people I used to work with at Bernstein. At that point, it had become AllianceBernstein, a big investment management company. There I really switched gears into kind of research, strategy. I mean, in some ways, what we had was a little internal think tank inside of the company, and I got to join that group. And so it was a very cool kind of experience of effectively getting paid to think about things and write papers. And so we used to produce these things called, they were famous on the street for being these black books. You remember these Bernstein black books? Anyway, the company would publish these things, and I was one of the people who would kind of go and create this kind of thought leadership, basically. That was probably the most fun, just because we're getting paid for idea generation, thought leadership, strategy, and so forth. And then 2007, 2008, financial crisis came. Doesn't look like anybody here was unlucky enough to experience that event, but it's as traumatic as you probably read or heard.
Everybody thought the financial system was collapsing.
It was bad news. And so the firm laid off 43% of staff. By the end of it, they were just packing people out and having security escort them out with boxes of their stuff.
Ouch.
It was a very ugly scene as Lehman Brothers was basically collapsing. I and one other guy who was a partner of mine managed to sort of survive this process, mostly because we had been tapped by the firm's CEO to effectively produce for him and then ultimately produce for clients and get out into the media and the marketplace to talk about sort of the nature of financial crises. How are we going to get out of this? What's going on, basically? And so they have dissolved our group, but the CEO said, we're keeping these two guys, they're doing this project for me. So, another sort of instance of just luck intervening. So we were just finishing up that research, feeling good that, we were still employed in one of the worst sort of market environments imaginable. I was home over the holiday break, and I got a phone call. The CEO got fired by the board.
Your ally at the firm.
Yeah, the only remaining really ally at the firm. And so my buddy, this guy John, who we were doing this research with, he and I were talking about, well, we got to imagine when we get back, Jan 2, that we're going to get kicked to the curb. Instead, what happened is we came in, the new CEO had us come up to his office and said, I really like this research. I want you guys to take it on the road, and I want you to finish it up, write this paper, take it on the road, and educate our clients and educate the people around us about what is going on with the financial crisis, etc. we did that, and then the market started to recover in March of 2009. We kind of wrapped our road trip, and I promise you this story is going somewhere, because we sort of looked at each other and said, well, we don't have a home to go back to. We don't have a group to go back to. We just finished the CEO's special project, and he sent somebody down to us to say, well, your group doesn't exist. We're not going to pay people to sit around and think anymore. You guys have been doing research for years on different type of things. Do you have anything you can turn into an actual portfolio, an actual strategy that this firm could launch? We sort of put our heads together for about 2.5 seconds, and we said, we've got this inflation research, right? This is something we'd had on the shelf, and real assets research. So basically looking at real estate, in particular in the listed markets, so REITs, resource equities, commodity futures, and then later on infrastructure. So those kind of 4 groups. And we had...
It's important to highlight that in that moment in time, inflation was pretty non-existent. So that was kind of a pretty brave, pretty brave presentation you guys put out, because inflation has been pretty mute for the last 40 years. So the time is 2010, 2011, and you're presenting an inflation project. That might have not landed well in certain boardrooms.
So what ended up happening, actually, to that point, is what I think that the firm was looking to capitalize on was the idea that all of the intervention from the Fed, the quantitative easing, that this was all new stuff, and there was a lot of worry in certain pockets of the market that all of this intervention was going to lead to some kind of inflation problem. We were in the tricky place of not thinking that was what was going to happen. To your point, right? So we found ourselves basically being tagged as the inflation guys, right? Who didn't actually believe that we were going to have an inflation problem, right? So marketing did not really care for that position. But fortunately, at that point, the firm basically said, all right, look, we like the idea, we like the strategy. We're going to give you guys 1 year to make this a real thing, write a black book, write a paper, and work with the people in the firm to create a mutual fund, just kind of normal 40 Act mutual fund like you'd see in any brokerage. They said, create this mutual fund, and we'll seed you with, I think they said $10 million, right? Which is minuscule for what we were doing. I think they ended up seeding us ultimately with 12 or 15. We needed to ask for more.
Approaching $2 billion today, right? Or
over that now.
Yeah,
but this is different. So what happened then, actually, this was still at AllianceBernstein. We started with nothing, and very quickly actually were able to kind of grow this business. I mean, really through just kind of pounding the pavement. I mean, this was, I and my buddy, walking into financial advisor offices everywhere in the country and just sort of trying to build something from nothing, right? And so I've probably never done so much travel and so much talking, sort of just pitching. This guy knows exactly what I'm talking about. But imagine I'm doing this in front of FAs all day.
All day long, right? You're talking 5-6 meetings a day. One moment you're in.
Yeah, because no institution is going to talk to us with a $15 million mutual fund, right? It's like we have to build it up.
You need to have a track record.
No track record, no assets. So you have to kind of build this thing from the ground up. By 2013, we had gotten it up to about $2 billion in that strategy. A lot of it, in fairness, was, or not a lot of it, less than half, but a substantial portion was sort of the AllianceBernstein sort of 401k plan. They were a different group than us. We had to pitch to them and sell the idea, but it helps that I actually knew these people, right? And
still doesn't make raising money from investors any easier.
Does not, right?
That's the hardest thing about our business.
Trying to convince at the end of the day, everybody in my seat is a fiduciary of some kind, right? And so everyone's responsible for somebody else's money, and so you take it very seriously, or you don't survive. In any event, we had pretty good success raising this, and what ended up happening ultimately is in a parallel fashion, Cohen Steers was looking to expand their kind of real assets platform, And in particular, they wanted to expand into kind of multi-strategy real assets, and they started looking for somebody to kind of come own that at their shop. So they found me, sort of, courted me in various ways and enticed me to kind of leave. For me, it was, I think, an opportunity, like everything is sort of just seizing opportunities and little slices of luck that come your way. But this was a company that was trying to build a big part of its business goals and structure around what I was doing, right? And so I wouldn't say that it was sort of a huge increase in compensation or anything like that, but what it was a huge opportunity to step into something, own it, grow it, and have the support of a firm that had its business strategy at my back. Whereas I would say at AllianceBernstein, much bigger company, it was more sort of, I imagined the portfolio would just survive as long as we could make it survive, right? There wasn't a strategy geared around it. So in 2013, I ultimately left, joined Cohen Steers. They had sort of a small multi-strategy real assets portfolio going. What they had, as we kind of led off with, was an excellent reputation in REIT investing, a growing fantastic reputation in infrastructure investing, so listed infrastructure assets, and they had just started to really branch out and build in-house capabilities around resource equities and commodity futures investing. So I kind of joined the firm with all of these resources at my disposal. I took the existing portfolio, completely changed its benchmark, its strategy, its process, basically built it to the way I wanted it to look and the process I wanted to have in place, which is basically teams of, basically taking the portfolio manager teams that do the individual kind of bottom-up security selection in their respective areas of expertise, put myself as the job of asset allocator, who gets how much money, right, at the level of the overall portfolio, and then assume the responsibility for effectively growing that business. So, being the top-down asset allocator, the risk manager for how all the pieces get put together, and the person who goes out yet again to sort of, go be judged by, guys like Kevin, whether or not we're doing a good job or we have an interesting idea. But I think when I picked up that portfolio, it had maybe 90 million in it. Most of it was money from the firm itself, seed capital, and then we had some, there were a number of kind of founders and basically wealthy individuals who had gotten this thing, to a mere sort of 90 million. Basically, since then, we've been trying to build a track record, generate outperformance as consistently and reliably as we can, bottom up, top down allocation, however we can get it. I think at this point, we're from 2013 till now. I'm going to get this wrong, but we've outperformed in at least 10 of those calendar years.
Well, I checked, and you don't have to brag, but I'll brag for him. So his funds have actually outperformed the benchmark, which is sort of like what they earmark their performance to. Their funds have outperformed the benchmark in almost every time frame we track. We're talking 1 year, 3 year, 5 year, 10 year, and since inception. That's important to highlight because studies have shown that roughly, I'm probably going to get this wrong, but somewhere in the neighborhood of like 80% of active investors fail to outperform the benchmarks they themselves pick. So, you don't have to brag, but I will for you. That is an elite track record.
Yeah, and I think I think it's a legitimate thing. I mean, I've seen this data too, and it's as bad as you can imagine. And so I think the firm, and this is maybe one of the things of being a specialist manager, right, is that we're not trying to do, be all things to everybody. It's sort of, what do we think we're good at? What do we think we can concentrate on? What part of our process do we think is actually repeatable? And then we just try to focus on executing and ideally not screwing too many things up, right? And so, it's not just my portfolio, but I think, the last thing this is all publicly available, so people can go fact check this, but something like north of 90% of the entire firm's assets under management is outperforming its benchmark on 1, 3, 5, and 10-year horizons.
Which is why I love you know, their firm and their strategies and the team. I mean, it's a group of really, really like intellectual people that, you know, have a lot to share. So I don't mean to go all over the place, but let's, because I mean, you share such an important story, and I don't want to gloss over this because, you know, a lot of the people in this room are kind of getting ready to go out into the workforce. And in a world of ChatGPT, where artificial intelligence is, you know, supposedly going to kick everybody's ass and, you know, replace everybody, could you talk a little bit more about just the sheer grit and hard work that you put in? Because it's important to point out that he became a father while he was pursuing his MBA, which is a 2 or 3 year commitment, and studying for his CFA, which is basically another MBA, a 3-year MBA, just self-studied outside of the college setting. So you're talking 5 years of education.
I was also the research, I was the research
Yeah.
assistant actually for my corporate finance professor in business school at the same time.
Ouch.
And I ran the investment club.
And you were still at work. So could you just talk about, because I feel like in today's society, a lot of us want instant gratification. And clearly your story was about just, you know, head down, hard work, smart work, but making it happen.
Yeah, look, I mean, I think ultimately everything's going to be a grind, right? And so you can either grind away at something that doesn't mean anything to you, or you can sort of decide to grind away on something that gives you a lot of upside, right? And I think that far too many people are just either not focused or not, you know, willing to do the work and feel like, well, you can, you know, take shortcuts, etc. And I think for me, and you know, partially it's, you know, the pressure of having, you know, wife and kids and things like that, but also it was the thing for me of just trying to be curious about what I was doing, basically saying, I want to do things that keep me interested, keep me excited, keep me engaged, so that I can, you know, muster the energy to pour all that much, to sort of pour that much effort into it, right? And so I think that's a sort of important thing is, you know, I'm not a huge fan of sort of necessarily, you know, follow your passion type things. I sort of think you can be passionate about all sorts of things. I'm probably more passionate about snowboarding than I am about anything else, but when it comes to work, right, it's sort of do things that are interesting, do things that are, you know, are complementary to your skills. And look, if you can do something that you're motivated to get up in the morning and actually, you know, go succeed, go make it better, think about things, you know, whatever engages your intellectual curiosity, like that's sufficient, I think, right? And then the other point I was going to make, and I was sort of saying when I reflect back, the untold numbers of times where basically nothing went according to plan and everything was about, well, some opportunity, right, presented itself, and just sort of basically having, you know, the wherewithal and to some extent sort of the willingness to take the risk to go take an opportunity, right? Now I would say preparation so that, you know, for that opportunity has been critical, right? Being in a spot where somebody said, you know, in their own mind, well, I think this guy's capable of doing this, but sort of having my ear to the ground and seeing, hey, this may not be what was in my, you know, 2-year plan, but all of a sudden I see something that's another door that's opened up, and I can see a way to make a hell of a lot out of it. I think that sort of willingness has been kind of important too.
And I think you proved that as being an investment banker, because in our industry, being an investment banker just has the worst reputation. You're working the most hours, and on a per pay basis, you're probably making minimum wage. And you knew that going into it, yet you still kept your head, you still worked through it, knowing that it was sort of like a stepping stone for what was coming on the other end of that, right?
By the way, it's funny that you mentioned the banking thing, because I remember doing the math, right, and looking at how many hours. It was basically, I remember looking and saying, I'm not making really any more money on a per hour basis than I was making actually before I went to business school. Mm-hmm. But in total, I was making a lot more money, and so it was just sort of a self-sacrifice of the hours, sort of, you know, walking out of, I can remember sort of many times, you know, walking out of my building in Midtown Manhattan at 4 o'clock in the morning on a Saturday, you know, because everybody wants to announce their deals on Sunday or first thing Monday morning, and so you're trying to finish all these deals over the weekend. So many weekends kind of lost, right? So I was kind of eager to get out, to get back.
And
to
you're
something
still
more
on
sane.
call, right? Because if the managing director finds, page 57 is missing a comma, they're not going to take care of that.
It's like hazard pay, basically.
Yeah.
I mean, that's what it is, right? It might as well be working pipelines or something like that.
I'm emphasizing this because a lot of our students are getting ready to hit the workforce, and it's in a world where you work in an industry like real estate where everybody's really intellectual, everybody's educated, everybody's really ambitious. You have to set yourself apart, and by doing things like getting your CFA, getting your MBA, doing these prerequisites like investment banking, which really is a prerequisite, in certain careers in finance. It really sets the stage for where you are today. Could you maybe tell us, we have a lot of, aspiring real estate professionals in the room. Could you maybe tell us, just knowing what you know now, right, from the seat that you sit in, you kind of get a good view of the landscape. You're watching Cohen Steers, which has a great training program, by the way. You're watching the trainees, get up to par. Knowing what you know now, if you were in undergrad, how would you approach the workforce, knowing that, artificial intelligence is coming down the pipeline, but there's still a need for the intellectual capital, and there's always going to be a need for professionals to manage money professionally on behalf of their clients. What would you do if you were sitting, an undergrad today at State Park?
Yeah, so look, one thing, I guess what I'm going to do here is speculate, because I don't think any of us really truly know what's going to happen with AI. And I myself have 2 kids in college, like basically your age, right? My daughter is about to graduate this semester, and I've got a son who's a sophomore. And so I'm trying myself to figure out what to tell them. What I will say is I use these tools, and they are miraculous, especially paid versions, right? And so one thing I would tell everybody is make these tools your friend, right? And I try to tell my young son, not your friend to help you cheat on your calculus exam.
My students heard that.
But learn how to use this as a tutor, as a complement, as a way to help solve problems and help you learn. I mean, I do this. I'm nearly 50 years old, right? I spent at least 3 or 4 hours of my day-to-day on Microsoft Copilot, which is powered by, I think at this point it's still powered by GPT 5.2, the thinking version, right? But it has a bunch of enterprise bells and whistles that the firm pays for. I had this thing doing unbelievable amounts of statistical analysis to actually replicate some quantitative models that I built myself on massive spreadsheets, a decade ago. The kind of work and the kind of thinking that back then took literally months to do. I did most of it with this tool in 3 to 4 hours this afternoon, had it replicate the bulk of that work on a spreadsheet, and it produces it in rapid time. And so I've been telling my kids, this is either going to be your friend or it's going to be your arch enemy, and I think you're better off treating it as a friend. I think early on I was a little bit sort of, if I thought about AI as just chatbots, that's the wrong way to think about it. To watch these things write code in Python and to prompt them to sort of reason through problems and give me what I know are the right answers, as I say, it's sort of miraculous. And so where I stand today, that'd be my advice. Hopefully, everybody here is using this stuff, I hope, right? And if you're not, find a way to get $20 a month. Get a Claude subscription and or a GPT subscription, or whatever suits you, Gemini. I think my own view is that Claude is probably the most user-friendly for a whole host of reasons, but GPT is a very good model as well. I just think, one way or another, this stuff is going to be in everybody's life and everybody's career. And it may start with kind of where we are now with kind of introductory white collar type work, but it's going to hit everything. To use the enterprise paid versions of these things, I mean, it's staggering to me what these tools are capable of. So that's a piece of advice I'm giving to my own kids. And I think my daughter, as an example, we were having a conversation about sales. She's interested in sort of getting into a sales role, and she kind of wrote something to me about, well, what could the role of this be in sales? Like, sales is going to be a person-to-person type of thing. But it was precisely the kind of situation where I said, think about all the different things that take place in a sales process, all the prep, all the knowledge. Think about the way you can use these tools, partner with these tools to make you more efficient than the next gal at sort of moving the needle. I think she got the message, but hopefully that kind of answers that question.
Thank you.
But who knows what's going to happen, right? I mean, all I can say is that people who say, well, it's a stochastic parrot and are unimpressed with the technology have not spent enough time with it.
I agree. I couldn't live my life. I wonder how I got through life prior to all this technology. But without, giving away the secret sauce, maybe we could talk a little bit more about, the finance stuff.
Yeah.
But can we just talk about on a high level, right? Because I always tell our students, in America, the tax code is designed for the job creators, not the job takers. Could you maybe talk about removing actually creating a profit for your clients? Could you just talk about how important is it to have a system in place to make investment-related decisions? I feel, especially when you turn to YouTube and TikTok for financial advice, the message that you see online is to day trade or to trade options and to trade Forex and crypto and all these different things. Yeah. It's been my experience that the professionals have a system in place that helps them make investment-related decisions that removes the emotion, removes the jargon, removes the vibes. Could you talk about maybe, from a high level, how important it is to have an investment philosophy, an investment process to make these investment-related decisions?
Yes, what I would say is pretty much everything you said is true, right? I'm trying to think of an example of this. Is everybody in my firm, everybody's going to have a sort of different process and a different approach and a different sort of investing style, let's say. But what they have in common is a process, right? And something repeatable. Where you look and you say, because the biggest risk is, particularly when you get into sort of thinking with a kind of quick buck mindset, I think it's the easiest way to kind of blow yourself up because emotions are the hardest thing to tame, right? And so for me personally, a big part of my process is sort of goes something like this, is one, we want to try to figure out what we think is being priced in the market. Sort of, if we just say, if we're trying to figure out, well, we observe some set of valuations or some set of assumptions about, cash flow, growth estimates, and so forth. What do we think is built into prices, right? And this is going to apply to any asset, not just sort of the assets that I'm involved in. But try to figure out what world, what kind of narrative, what kind of expectations are already in the price. Then the question becomes, well, how do I, am I able to develop some kind of divergent view? And very often the answer is no, right? I don't really do individual stock analysis anymore, but I used to. And very often what I would look is I could look and take in a whole lot of information and everything else and look and basically say, the market looks actually pretty efficient. These things, I don't really have a very different view. And then periodically, right, you look and say, I think something's being missed here. The work would be, what is it about my view that is different in the market? And then have some process for trying to price that, right? And so my process these days from top-down asset allocation still follows those types of principles. We look, we try to figure out, what's in the price, what kind of expectations are baked in. We try to think about, is it sensible what we're seeing, whether it's sort of valuation multiples, growth expectations for an asset class, what have you. And then we probably spend most of our time reading, talking, and debating with each other in meeting rooms about what do we really believe. all in the hunt to ask ourselves, do we have some kind of divergent perspective on a particular macro story, an asset class, or all the way down to sort of industry and sector security things. And then I think a big part of the process for us is risk management, right? Is how much do you want, how much of a risk budget, understand what kind of risk budget you have, how much do you want to spend on a particular idea? Like one thing I can tell you is we don't ever sort of go all in on some single idea. The biggest thing that I search for, and one of the main things that I think about when I try to put my portfolios together, again, drawing on sort of sub-managers in their own spaces, is I want to have the expectation that everybody is positioning themselves to outperform for their own kind of idiosyncratic, process-specific reasons. Basically, I don't want us all having a bullish oil trade on at the same time, or we're all loaded into a value style factor, or we're all loaded into just a hidden trade that only really works if the market goes up. These type of things are very easy to get wrapped into as an investor, unless you have a sort of risk management process. And so for me, the whole alpha process, as we pull it together, what I want to see is alphas, expected alphas versus benchmarks that aren't correlated with each other, right? And historically, we've had about a zero correlation. What that helps with, right, is that if you think about over time, the expectation is that at any point in time, someone is going to be, even if everybody has skill on average over time, at some point in time, people are just going to be unlucky, right? And they're going to be underperforming. But if somebody else is outperforming, right, then there's sort of like, there's sort of ships crossing in the night, but in the long run, if everybody has a positive outperformance, then when you look at the level of our overall portfolio that has all these varied ideas in it that diversify each other, at the end of the day, what we end up with is basically a big portion of outperformance just plops right on top of the portfolio and comes with very little risk because of the way we've diversified things. And so we sort of think about it in some ways like, in a portfolio like mine anyway, is we're out there really trying to hit singles all day long, maybe the occasional double. And if somebody swings for a home run, it's just not going to be in the DNA of what we do, right? It's sort of in the long run, to go back to what I was saying earlier, is we're fiduciaries. We're trying to not blow people up, right? We're trying to give a level of outperformance that we think makes sense, we think earns our keep, will keep investors with us, but also allows them to stay invested, right? And the biggest thing I've seen in my career is that people think that they have a big tolerance for risk until the bad thing happens, and then you really get to see how people behave. And more often than not, my experience is that the imagined risk tolerance, whether it's one of us in this room, any type of individual or institutional investor, they're generally poorly calibrated. They cannot handle nearly as much risk as they think they can. And so I've sort of taken up on myself as a manager and as that fiduciary to try to build and construct and manage a portfolio that sort of peers over their shoulder a little bit and sort of says, I'm not going to ask you to have too much of an iron stomach for risk, intentionally by design. And I think it's a better way to sort of keep people invested. The worst possible thing that can happen is you get a bad realization, people freak out, they press the sell button at precisely the wrong time and end up making a life error. Right? Much of which I saw, by the way, in the financial crisis.
I feel like as a financial professional, whether you're a portfolio manager or a financial advisor, 90% of the job is just telling your clients, don't hit the sell button. You tell me otherwise. But so let's double click on your maybe day to day, because you're a professional that has managed pools of billions of dollars several times. Yeah. Could you, and of course you oversee other investment professionals that also oversee pools of money that are into the billions. Could you maybe talk about just the day-to-day on a role of being a senior portfolio manager of an asset management firm? Different than financial advisor, because you're not like managing money for, rollover 401k plans. This is institutional money. So maybe you could just talk a little bit about the day-to-day.
Yeah, I mean, look, I think one of the strangest things about my day-to-day is probably the amount of time I spend reading and thinking, right? Virtually everybody in my seat is walking around with, a little notebook, right? Where all they're doing all day long is digesting information, thinking, and going through this process of trying to figure out, again, what's priced? Where do I think something might be wrong? Where is there an opportunity? And so for me, look, a day is going to start, I don't know, I wake up at 4:45 typically, kind of get myself together, get on the train. I live in Fairfield. Into work is, for me, I walk to the train, I walk to work. It's sort of an hour and 40 minutes door to door. Very often I'm listening to podcasts, whatever, basically financial news, whatever is interesting from an investment perspective. A lot of AI recently. But I'm listening to something, I'm being productive in some kind of way, thinking while I'm sort of commuting. Then I'm going to get in, and the first thing I'm going to do is sort of log into the Bloomberg terminal, and I'm just inundated with information about my own portfolios. As you can imagine, we get all kinds of reports. Well, this looks weird.
So it's like 9:30. You've already taken in 3 hours of pure information.
Yeah, well, and even before then, right? Yeah, that's basically just absorbing information all morning long. I mean, we don't even have our trading meeting until 8:45 or something. So typically, I'm at work for over an hour. And I've kind of checked all portfolios, made sure there's no major issues. I was telling Kevin before I came in this morning was one of those days where everything went wrong, and we were trying to figure out why. And it turned out that our data provider missed a decimal place on the price of soybeans and soybean oil, and so we were getting alerts that we needed to meet margin calls that we didn't need to meet. That somehow we'd underperformed by 600 basis points overnight.
That would send everybody at the firm into a frenzy, because when you're managing billions of dollars, a rounding error like that is like millions, tens of millions of dollars. So,
and it's wrong. The question is why is this happening, right? And so there's always some weird little fire drill like that, or not always, but sometimes weird little fire drills. But mostly it's absorbing information. I have a lot of kind of meetings during the time, or typically the cadence of these things, ideally, is they're sort of short, to the point type of meetings, if we can get them that way, where, I'm going to give an example. Right now, one of the bigger controversies I see in the portfolio is trying to figure out how attractive is an investment in sort of, a diversified investment in listed infrastructure relative to, say, listed real estate. There are some details that I won't go into, but what it requires is me trying to figure out from our infrastructure managers, what do they really believe, right? In particular, what do they believe about the growth profile? Because much of infrastructure right now looks like it could be looking at very strong growth. I mean, you've got power generation stories, right? You've got data centers. You've got basically the picks and shovels aspects of this AI investment, right? So we're not going to be invested in these companies, not in the hyperscalers, but power generation is a big part of our real assets universe. We're going to see power generation and power demand grow in this country basically for the first time in forever, like a decade. And so I've had meetings with our infrastructure managers to try to really ask them the hard questions about what they really believe on the growth side. There's those types of meetings. There's going to be sort of sales and marketing type meetings. Right now, I was doing some meetings because we have to present to our board, our mutual fund board, right? Where this is the kind of thing of getting grilled by, a sort of set of third-party directors about the portfolio. Fortunately, we had great performance. It should be an easy meeting.
On the flip side, not always. The flip side, if it was poor performance, right? You're losing that money.
Then there's talk is remediation plans, right? When you have how do you plan to fix this? Right?
And of course, as an investment professional, you don't have to be specific, but bonuses, salaries, everything is tied back to your performance. Am I correct in saying
That's
that?
correct. Yeah.
So if you're having a bad year, it's safe to say we probably won't be,
Yes,
having a great year the following year.
So we haven't talked about that. I mean, that's another sort of part of this business is I think a lot of times the discussion is like, well, what are people getting paid and so forth. The answer, though, is for the most part, it's highly volatile, right? Like if you were in my seat, you signed up for more or less, you sort of eat what you kill, right? It's like you're only as good as you actually generate results. And in these markets that are, frankly, way more efficient than probably any of us working in this business want them to be, it's a big thing to sign up for. And so there's that element of also, being prepared for lean years, right? Just even if it's just bad luck, right? Is that if we don't generate the outperformance, well, I mean, it's not totally a sort of set scale, but on the whole, I would say something like 75% of my compensation is going to depend on whether or not we outperform, right? Whether or not I've generated outperformance. And so if I don't generate outperformance, well, I know that what's going to happen is,
it's going to be a rough year next year.
It's going to be a lean year, and you're motivated to try to do better next year.
Exactly. Story of, when you're young and you're trying to get started, every year is leaving, so be prepared for that. But maybe we could go into some, because we're rounding out third base here, maybe we could just go into some, flash questions, sort of say. Maybe you could just tell us a little bit about, what you're reading these days, what podcasts you're listening to, what newspaper or media outlet students should be reading religiously on a daily basis.
Oh, man. This is it's a little bit tough for you guys because a lot of what I read is research, sell-side research, right?
Very technical.
So what ends up happening is...
But we do have Bloomberg terminals.
You have Bloomberg terminals. So you get a lot off of Bloomberg.
Yeah.
It's a great news consolidator. But what I get is because we have your brokerages and research providers, they all want us to be their clients, right? And so I get a lot of specially tailored kind of research that isn't publicly available, okay? So that is one of these things that just comes from being involved, right? But again, Bloomberg Terminal is a powerful tool that everybody uses, right?
The whole industry.
And
you all have access. Make your way over to the business school.
Yeah. And again, as a news aggregator, it's actually pretty good, right? I mean, you don't have to have a subscription to the Journal and the Times and the Post and all that. It's gonna pick the most relevant articles and so forth if you want to read that. What am I reading? So I read more sell-side research than I read anything else. And so this is going to be stuff where, I don't know, I mean, I'm working from home tomorrow. I've got some family stuff to deal with and a very early meeting with Europe. And so I've got at home in my backpack a stack of papers, about where we stand with the natural gas pipeline demand right now. Like, these are things that are very tailored to what I'm doing. Exactly, midstream energy. Podcasts, God, I listen to a lot of stuff.
I recently seen Tyler on Odd Lots.
So he was on Odd Lots.
That was amazing.
So Odd Lots I listen to. That's a good market podcast. Tyler did a nice job on that one too.
Yeah. Tyler's one of his portfolio managers.
He's one of my. He runs resource equities for us. I listen to a lot of wacky stuff. Like there's a podcast called Doorcash Podcast, where it's kind of a nerdy guy talking about mostly AI these days. What else?
Anything you streaming on Netflix? I know myself, I'm streaming Titans of Finance on Netflix, and talks about industry titans like JP Morgan and other financial professionals.
I'm trying to think. When we're streaming that, it's what does my wife want to see? Yeah. Which usually involves somebody getting murdered and a crime needing to be solved.
That's what me and my wife watch.
There it is.
She knows the good stuff.
Yeah.
But yeah, I guess really, I mean, I would have to look at my podcast feed. But I'll tell you, I'm eclectic. I mean, I listen to history podcasts. I listen to a lot of, political stuff. I listen,
I'll spare you of the political questions.
but knowing what's going on. I mean, particularly for a lot of our assets, there's a lot of regulatory risk around a lot of our stuff. So you need to know what's going on there. I don't know. I must subscribe to 500 different podcasts.
As do I. As a financial professional, you'll all find, or a real estate professional, you have to take in information. My wife who's in the room will tell you. I literally, even in background noise, I always have on Bloomberg or CNBC. If I have to use the bathroom in the middle of the night and I see a headline come in, like I'm up for the rest of the day because I have to do my research. I got to see what's going on.
Yeah.
So would you agree? Like,
yeah, there's something about
information.
There is something about just sort of integrating yourself in some kind of information landscape.
I feel every financial professional, all the CEOs, everybody has these things on in the background. So the message here is to stay up to date on information.
Yeah, again, I mean, if you think about it, it's going to be hard to know what the world is pricing if you don't know what's going on in the world, right? And so,
I think the perfect example, and we're not going to get political or anything like that, but just something that happened in the last 48 hours. There's some turmoil in the Middle East, and as a real assets manager, you have to stay aware as to what's going on over there. Not because we want to have a political view, but because you're making live investment-related decisions based off of what's going on over there. So it's important that you stay up to date because
it matters in particular for us what happens to the oil price.
And especially as a real assets manager and in real estate as well, right? Because these commodities have to make it to the construction site for the construction to happen. So very, very interesting stuff.
Yeah, all those types of things make sense.
And it really is, so from a macro level, it's all intertwined. So, Vince, we appreciate you coming in. Maybe we could just take, I know we're rounding out the hour. Anybody have any, maybe we could open it up for 5 minutes of Q&A. Any students have any questions or anything like that? I know I have one more question. So, if you don't mind. Yeah, you know how it is. We always have these pressing questions. So, maybe you could just tell us a little bit about how you, spend your free time. I know you mentioned snowboarding, but as a financial professional who's always taking in information, what do you do to hit the
You know what my answer is going to be to this because you know what I do.
Well, we'll share it with the class because...
I mean, look, so in the winter, I do a lot of snowboarding on the weekends, but when the weather is right, I'm always outside, always walking, jogging, exercising, and always with headphones in, listening to something.
That's important.
Something that, if it's not finance related, it's going to be history or it's going to be some type of current event. So, I sort of just never stop. I'm just always devouring some type of information, right? And I think that that kind of intellectual, at least in my seat, right, and what I do, that level of intellectual curiosity is basically just sort of required. I mean, more or less everybody who I work with is some kind of weird information-consuming animal like this, right?
Yeah.
And so...
But it helps you professionally, right? Because you might spot an opportunity to make an investment-related decision that only you can come up with that because you were the one doing the research and you know what the market holds. So
and the investment team just had a trivia tournament, and guess who won?
I wouldn't be surprised if it was you, right? Helps that he's the boss, right? So, Vince, we have two gifts for you. We have the politically correct one and the politically incorrect one. So this is from the school.
Do I get to make a choice?
No, you're going to go home with both, but I think I know which one you're going to like more. So this is from the school and the staff, and everybody's wanted to thank you for coming out. You got some cool Sacred Heart swag. He lives in Fairfield, so you can wear this around town proudly. Nobody knocking on his door. And then you have the politically incorrect one, which of course Professor has to get. So hopefully you can enjoy this chilled bottle of champagne with your wife this evening.
Absolutely.
And this is just a token of our appreciation, for taking the time out to visit us here.
Well, cool. I appreciate it.
No.
I appreciate the opportunity, and thanks for you guys putting up with me for almost an hour.
No, we thank you, Vince. Thank you. Let's hear it from Vince, guys.